Hey, this is Sasha. Thanks for joining me in today's video. And today we're going to take a look at why many option traders, when they're swing trading, let's say call option contracts, why they lose money and why they fail. So stay tuned. I'll share with you some tidbits and insight on this. Okay, so to kick things off, a lot of people, they go in and they try to trade options like they do stocks. You buy low, you sell high. You buy low, you sell high. This is what they try to do, and you do this usually with calls. So you're buying a single call, and then you're selling the call at a higher price, right? You buy something for $5, you sell it for $6, so you make money. You buy a can of soda for 50 cents, you sell it for $1 at a park. This is what happens, or $5 at a park. So before we get started in talking about this, I do want to give you some insight on checking out our website. There's a lot of great getting started pages here, so check those out. Option trading, just getting started in general, day trading, penny stocks that we're looking to evolve here further. And as you go in there, check out some of the freebies that we have. There's also some one-on-one coaching if you need some direct help one-on-one directly with me. Not an assistant or something like that. So we'll be directly speaking through video. You can learn more about that, and tons of great courses if you're really into options and you want to learn in detail. So with that in mind, let's take a look at kind of this position here that I have. And here what I have is what's interesting and fascinating is that a lot of people, they get into buying shares of or contracts of call contracts because they try to trade it kind of like a stock. So here I have a position on Square, and you can see this position right now is down about $38 or so. So it's 200 or 100 shares. And when I have these 100 shares, I have a delta of basically 100. Now this delta of 100, what that means is that if this goes up, let's say $1, I make $100. So let's say we move it $10. What do you think we're going to make? 10 times $100, you'd be about $1,000 positive. And you can see right there, there's that price slice. So you can see as I move it, there you go, that's what it means. Now, what most people get is that, hey, okay, I get it in the fact that if I move this price and I move this price up or down, I make money. So if I buy the stock and then I go ahead and buy it at a lower price, I get out at a higher price, I make money. You're dealing with price. And this is what the delta tells you. It's the delta, that's the risk factor that you have, but it's also your profit, your money maker. Now there's also this gamma, theta, vega, and this is what people don't get. These are zeroed out from in a stock because you don't have that in a stock, but they're still there, and you might be wondering, well, why are they there? Well, what a lot of people don't get is when they go from trading stocks and they go into trading options, they don't consider the gamma, theta, vega factor. And when you look at this call contract, which is very similar to what we have in the other one, in the stock area, but now we've got a gamma, theta, vega. Now we still have a delta, and this delta is 81, which is kind of like 81 shares equivalent of stock. 81 shares of stock should, in theory, as it moves and wiggles around, should make you money as it goes to the upside, or at least not lose as much or as badly. Now you can see with this one what's happening, and I put these positions on almost at the same time, within 1 or 2 minutes of each other. What's happening with this one is I'm down $135, and what's happening with this one is with the stock, I'm only down 50. So why am I down only 50 on the stock, but on the option contract, I'm down 130. You might be wondering. And take a look at when I executed these two trades. So you can see here is Square right there, and there is the Square position. And within basically at 11:04 and 11:02, within 2 minutes of each other, they were executed. So it's nearly the same exact kind of price there. So don't let price be, I mean, again, it's not fully equal. I probably should have just blasted all of them, but I didn't put them on at the exact same time, but close enough. And here's the thing, is when you look at this, you're losing quite a bit more than you are with the stock. And you might be wondering, well, why is that? Well, a lot of this has to do with, because people don't understand how options work, is that you have a time decay problem. Here, you are losing $24 a day, and sometimes that picks things up a lot faster. So that's 24, then 25 the next day, then 26. So think of it right now. We are down $125, okay? So this $125, if I move the hypothetical date here, look what's going to happen to the profit and loss relative to this theta. every day you should be adding to that loss. So now you're down about 125. The next day you'll be down about 150. So take a look. I'll add an extra day. There you go. You're down about 140. Add another day. Look at that, 164. So a few more days into the trade, you're down already $272. So you need to make up that difference, because that red line, that little tick right there that you see, that's your zero line, your break even. So this is at zero. Look at this big dotted line right here. That's your zero line. Okay, so take a look. There it is. There's your zero line. And that's what that red tick represents. And now, as I move this forward multiple days, look what happens to this tick. It's going to go to the right, which means you need price to keep going and go even further to the upside for you to break even. So that's one thing that people don't get. That's the first. Now here's a little bonus thing. This is what I wanted to chat with you about. Think about it. What do you want the stock price to do? You want it to go ahead and go up, right? You have a positive delta. You do have a negative theta, so time decay works against you. Maybe you get that part. But here's what people don't get when they get call options. You also have a positive vega here. Now, what does that mean? This tells you that you're kind of long or short stock in this case, if you think about it. What's really happening is it's part of your position. It's part of what creates the value for that position. And you're making some money from price, you're losing some money here on theta, and now are you making or losing money on your vega? So how do you make money from vega when you have a positive vega? You need vega to go up. But how do you make money from a stock when you have a positive delta or a positive stock? You need stock to go up. So here you need vega to go up. So when does vega go up? Well, let's go ahead and adjust the vega. Vega goes up when volatility goes up, when stocks, what do? They have to drop. So if we go ahead and bump this vega up 3 points, you can see I lose less money because I'm making money. That's if all prices stood still, right? So there, I bumped the vega up 7% points, which is a lot, and it cushions me and helps me out. 9, boom. But think about it this way. We are positive vega. Positive vega. What does that mean? Positive vega means I want volatility to go up from the volatility perspective. So I want volatility to go up, but I'm positive vega and I want price to go up as well. So what happens when price goes up? I want price to go up. I bought this because I want price to go up. But if I want price to go up, what's going to happen to the volatility? When price goes up, volatility goes down because things are more calm, right? They're not as crazy. So when price goes up, volatility goes down. So let's go ahead and move this down 3 points. So look at what happens. Actually, you're chasing. So you can see what's happened is as I reduce that volatility, you're losing more money. So not only are you losing money from the volatility, you're also losing money from the time, the theta. That's the big issue with these single call contracts. If you're just doing them on their own, they're great for hedging. Like let's say you got a butterfly and you buy a call contract. They're fine for these kinds of concepts. But when you're just thinking about buying single call contracts for speculation, that's a bit of a problem, especially when you've got this positive vega and you're assuming and you want things and you want the price to go up. Well, when price goes up, volatility goes down usually. And what's going to happen right there is you're going to keep losing money as the volatility goes down and with the theta. So you got to make up quite a bit on your deltas to make it even work. And that's what most people don't get. So I hope this gives you an understanding of why a lot of people fail when it comes to trading single call contracts. In the same concept, single put contracts can lose money as well in a different way, also time premium and volatility, but a little bit different, right? When you really look at things, you got to look at things a little bit more multidimensional, because this is what stocks options are all about. With a stock, it's single dimensional, meaning you buy shares, you sell shares. It's a price. When you look at options, you're looking at time value, you're looking at volatility value and price value. So there's multiple factors to consider. These are the things that we cover in the courses. These are the things that we cover in some of these freebies here in the Getting Started pages. Check out some of those things. And if you really want some in-depth sessions, you might want to check out the coaching where we work one-on-one. So I hope you found this video helpful. It gave you some things to think about. Grab some of the freebies that we have by clicking the link right over here, or subscribe to the channel if you're brand new. Thanks for joining me, and hope you have a great day and great week ahead. I'll see you next time.